Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI, and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Victor Adair, co-founder of the Polar Futures Group. He's Senior Vice President and Derivatives Portfolio Manager at PI Financial in Vancouver. His website, polarfuturesgroup.com. Welcome back to the show. And what happened with the U.S. Fed today? I know people were really anticipating the meeting. President Trump demanding lower interest rates. What happened?
The Fed meeting today, I think, was maybe one of the most anticipated meetings, but it seems like they all are. The market has been, over the past several months, has made, actually, a real 180-degree turn from what they were expecting in the future as far as interest rates are concerned. You go back to last November, say October of last year, the market was pricing in at least 2 interest rate increases in 2019, in addition to the one that we got last December. Currently, the market seems to be pricing in 3 cuts to interest rates from the Fed this year. So that's a heck of a swing. We've seen a big rally in the euro-dollar contracts, and we've seen a big rally in bond prices, whether it's the 30-year bond or the 2-year note, everything in between. The market was expecting from the Fed today, and let me preface that by saying, and the Fed has been behind this change, or have been running late behind this change that the market has had. So in a way, the market was expecting the Fed today to sort of catch up with the market. And what catching up would look like would be to give the market an indication that, yes, they are going to start to raise, lower interest rates. Bottom line, the market is very little changed here right now from what it was before the Fed came out and gave everybody their opinion about what they see, what they do. I think one of the key words was they are going to be less patient, that the risks are moving in a direction where they will start to lower rates. But as I say, the market has been pricing this in for some time, and sort of this is not at all unexpected. So very little change in the credit markets and in the stock markets. A little more change in the currency market, but maybe we can get to that in a minute.
Has the president been making noises about firing the Fed head if Jerome Powell doesn't make these changes?
The president has been making a lot of noise, generally tweeting, but sometimes speaking, that he doesn't agree with the decisions that Chairman Powell has made, even though President Trump did pick Powell for the job. I think the president has been unusually vocal in his criticism of the Fed. I think it's too bad, but that's what the president is like. He just does that sort of thing. So, and it seems today certainly, Fed Chairman Powell was asked directly if he was to get more, this is my language, if he was to get more heat from Trump, would he quit? And he said no.
If lowering interest rates was so helpful to an economy, how come the zero interest rate in Europe hasn't done much for the European economy?
I guess the short, smart-ass answer to that was that the European economy was in such a mess anyway, it was hard to figure out that anything would get it out of it.
Now, during our most recent interviews, you talked about how the markets anticipated interest rates. We've seen bond yields drop like a stone since that talk. Where do you see interest rates going?
Well, that is the $64 question. As I was just saying, we had that huge swing from last November, and the swing, I think, was predicated on on the one hand, there has been certainly a slowing of the global economy. The other thing was that inflation remains subdued, at least the inflation measures that the Fed looks at. So from that point of view, you might think, leaving aside the chirping from the cheap seats we get from the president, leaving that aside, there was some thought that maybe the Fed should cut rates. On the other hand, you've got the stock market near all-time highs, unemployment's at 50-year lows, and it's not as though inflation has fallen down to deflation. So there's been reasons, I guess, good reasons for the Fed to just kind of be steady as she goes. Where do we go from here? I can make guesses. I read a lot of research. One of the people I respect, David Rosenberg, for instance, and he maybe sort of carries the flag for people with this kind of a point of view. He's quite convinced that we're already in a recessionary environment and that it's going to get worse as we go through this year, and that sort of because of that, the Fed will start to cut, and that within a year or so, we will see the yield on the U.S. 10-year, which is now, call it just above 2%, be down in the area of 1%. I mean, that is a very big rally in the bond market. And then, further out from that, a year or two out from that the central banks will actually just finally monetize some of the government debt. That's MMT writ large. I can imagine that, but, what I try to do is trade price action, and I think that in the short term, which is where I do most of my trading, that the market has probably got ahead of itself in terms of, marching to the tune of we're going to have much lower interest rates, any day now. And I'd be inclined to think that the bond rally, is extremely overbought and probably liable for some sort of a correction. So, I've got my time forecaster, my time zone where I trade is pretty short term. And anything, where somebody talks about, where markets are going to be 3 years from now really doesn't interest me, and there's nothing I can do with that information.
We'll have more with Victor Adair right after this.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Victor Adair. Victor, the stock market had a big dive late last year, then came roaring back. There was a correction in May. Now the market is back near record highs. What are your thoughts about these big bounces?
Well, in one, again, with my time frame being fairly short term, is how I trade. But let's just take a view here and say that really over the last 18 months or so, we've had the Dow Jones make a triple top. We had a high in January of 18. We had another high in October of last year. We've had a high here in April that were all about at the same point. So really, if you wanted to sort of paint a bearish picture, you might say the stock market's gone virtually nowhere. That's the Dow in the last 18 months, and we've had this incredible volatility. And that might account for what we've seen is that people, in fact, are taking money away from the stock market and putting it over into the bond market. Perhaps that's just the population getting older, and that's a sensible thing to do. Perhaps that's people they don't like the volatility. They get a stomach ache when they open their statement, or before they open it, wondering what's going to happen, and they want something a little more subdued. We've seen the bond market rally, stock market not so much. So even, by the way, that's just not people at the breakfast table. That's money managers seem to be, or people that are running pension funds, that sort of thing, seem to have a higher cash position now than you might have expected. In other words, a lot of folks are cautious here with the stock market. The concerns have been certainly trade. We have had I think the sentiment on trade swung from, gee, we're going to get a deal done and that'll be wonderful. And now it looks, this is with China, and now it looks that maybe that's not going to happen, that we've got a slowing economy, certain sectors of it, other sectors seem to be doing fine. And then there's, I think the anticipation that the Fed would be cutting rates has been buoying the stock market, as have share buybacks. And you kind of wonder, well, are we running on fumes here? And if in fact that the rate cuts that might come from the Fed are good news for the stock market, but then you think of, well, why are they cutting rates? Well, they're cutting rates because the economy is not doing so good, so maybe that's not good news for the stock market. I'm not wildly bullish or bearish on the stock market. I'll trade price action one way or the other, and I haven't done much of that lately. So, but I am not of the camp that thinks the stock market just going to make a run for the roses here as we go from now to the end of the year.
You've been bullish on the U.S. dollar for quite some time. Are you still bullish?
Something, you're right. I have been pretty resolutely bullish the U.S. dollar. I mean, from time to time I've seen some small swings in it, but I'm wondering, and that's sort of the first step I go through before I start trading the other way. I'm wondering if the U.S. dollar isn't starting to look a little toppy. Let's call it here the last month or two. And it's certainly, if anything, the volatility in the currency market has been very low relative to volatility over in stocks or the bond market. Bond market volatility is very high relative to where it's been before. But we're seeing some signs that the rally in the U.S. dollar is losing steam. I think part of that is there's been the American market has had a huge interest rate premium over most other currencies. Certainly there are current countries out there with higher rates, but by and large, for the main currency markets, the United States has got a premium. I mean, when you have German 10-year bonds, for instance, trading at maybe minus 30 basis points, and the U.S. is trading at 200-plus points, that's a big swing, to decide which way money's going to go. But I'm just thinking that it begins to feel like maybe the U.S. dollar is getting a little high. Then at the back of my mind, and it's hard to not be reminded of this, any day you could get a tweet from Trump, or he could have call the Treasury Secretary in and say we want to lower the dollar, that these other countries are treating America unfairly. So, there's that. But then on the other side, you look at Europe, you got Brexit, you got problems with Italy, you got Germany vulnerable to any slowdown in trade. You just wonder, well, if you don't want to be in the U.S. dollar, where do you want to be? And that's important. I mean, the U.S. dollar is where capital goes when it's uncertain, or certainly if it's worried, it goes into the U.S. dollar. I'm thinking that maybe the U.S. dollar is getting a little toppy. I haven't taken any significant positions on that, but I'm looking at it that way.
Conversely, what's your position on the Canadian dollar? Have you changed your mind about it being bearish?
Well, again, you're right. I've been sort of routinely bearish of Canada for the past few years, but certainly in the past year or so that we've been doing these interviews. I mean, we were 83 cents on the Canadian dollar just coming up just about 2 years ago, and now we're been down 74 cents. I think the things that influence the Canadian dollar, the U.S. dollar relative to most other currencies is the most important thing. So if the U.S. dollar is generally going up against the yen and the euro and the Swiss and the Norwegian krone and so on, it's probably going up against Canada, and that's been how it has been for the last year. And so the interest rate differential, as I've said, the Americans, you get more return by being invested in U.S. dollars than in Canadian dollars. On and off again, Canada will trade in relationship somehow with the price of oil, particularly WTI, and the broad commodity indices. But, and here's the but, you must have felt this coming. One of the changes here has been that it looks as though the Bank of Canada is going to be less likely to cut rates than the Fed, and that plays to Canada's favor. And now it's possible that if the Fed starts to cut rates and you look to the reasons why they're doing that, the Bank of Canada will see similar things and, will follow, but probably follow with a lag. So I think of most of the currencies that are out there that you could trade the U.S. dollar against, and I have, 2 weeks ago I was trading Canada from long side. It was short last week and back on the neutral side right now. But Canada, I'm not anywhere near as bearish on Canada as I used to be, and I'm beginning to think that if the U.S. dollar is turning, Canada might be a good candidate to buy against the U.S. dollar.
We'll have more with Victor Adair when we return.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Victor Adair. Victor, over the last few months, you've been trading gold from the short side, but have you changed your mind about gold?
Yeah, I am, and I have been trading gold from the short side, but again, it goes back to the U.S. dollar. I mean, the most important variable, sort of day in and day out over the years has been how's the U.S. dollar doing, when you're looking at gold. And if the U.S. dollar is going up most of the time, that's a headwind for gold, and it's not a headwind, maybe worse than that, more like an anchor around the neck. We have had times like we had last week when gold and the U.S. dollar were both going up at the same time. To get right to the recent past here, gold I don't think is traded above, and certainly not for any significant period of time, above 1360 for the past 3 years. It looks as though there's selling above the 1350 level. Everywhere I look, it seems I see, call it research that is pointing out that there's a great opportunity here for gold to break out to the upside and take a run, and the usual bullish arguments for gold are set out, and people get really excited, for instance, with geopolitical events like the recent attacks on shipping in the Straits of Hormuz, Gulf of Oman. I mean, I've traded gold for 50 years, and the Strait of Hormuz has been, one of those red flags you wave at the gold bull since I can remember, and we've seen in the futures markets the increase in open interest. That's the total size, the number of contracts that are open has jumped about 20% in the last month. Speculators are now the most net long gold they've been in 15 months. So people have been buying gold in anticipation of if we could get above 1360, it could be a run for the roses. Now, gold has also been up against nearly all other currencies except the U.S. dollar, and has made new all-time highs in some currencies. And forgive me on that, I think certainly Australian dollar, Canada's close, some other currencies probably as well. To come right to your question, I'm not so sure that I'm not trading gold from the short side. Haven't been, at least recently here. I was last week, covered that position. Gold, if the U.S. dollar is changing, then gold's going to be changing too, and I'll be looking at the price action more than anything, as opposed to forecast that something dreadful is going to happen, and therefore you need to be long of gold.
Lately, the price of oil seemed to mirror what was happening in the stock market, going up and down at the same time. But recently, that bounce hasn't happened in oil when the stock market went up. Has that relationship broken down?
It looks as though it has, and you're very right on that. I mean, crude oil and the stock market, say, both made a high. They made a high in January of 18. They made a high in October of 18. They made a low at Christmas time together, rallied from Christmas to the highs in April, and then both fell together in May. But since then, we've seen the stock market bounce back, and crude oil is still heavy here, just around $52. There has been a change in the relationship. That might be too tight, too short a time frame. I mean, the high we had back in April on WTI was sort of synchronous with the ramping up of sanctions on Iran, and I remember using the term then, as good as it gets. I think also, in a way, that the crude market was strong because the stock market was strong. When we had the break in crude from those highs, the volatility in the options on crude really jumped, and there were some great trading opportunities there. Some of the fundamental news was, there was rising inventories. There was thoughts that there was going to be weakening global demand. U.S. production had hit new all-time highs. I think it was above 12.5 million barrels a day. There seems to have been a breakdown maybe there, and that often happens in markets where you see a relationship and you think, hey, well, this thing is going up, and every time in the past when this thing has gone up, this other thing moves. So, you put that trade on, and just when you finally do that, then the relationship breaks down. Right now, again, with crude, I'm going to be looking at the price action rather than trying to make a forecast as to where it should be going and why.
Victor, you've got about 40-plus years trading experience. What do you think is the most important thing that people should consider, or things they should consider, before they start trading commodities or currencies?
Well, if you're going to be doing this on your own, and let's say, first of all, if you're going to trade with a broker, then I think you want to find a broker that you get along with. Somebody who listens to you, somebody who's got your, hears what you have to say, understands you, and that doesn't need to be the sharpest tack in the box, just really. And it's probably not going to be the first broker that you run into. You may have to look around a little bit. I think maybe that if we're going to be trading on your own, like just online trading, that, you're going to have to try different styles, different ways. In my experience over the years, I've seen people be very successful trading their own accounts, and the methods that they use, the way they go about it, is different as chalk and cheese. That different people need to trade in different ways. But let's say you find a way to do that. For me, for instance, I read all kinds of research and opinion pieces, but I trade price action. Not the forecasts. If I find some guru who says gold going to the moon, I don't go out and buy gold. I'm going to look at the price action in gold. But I think maybe right at the top of the list is managing risk. Gee whiz, we read books about some guy who did really well in the markets, but there was, 500 other guys who were out there at the same time he was, and they didn't do so well. So, we read about that guy and think maybe it's easy. To me, managing risk, what does that mean? Why would you make a trade? What kind of size are you going to put on? What kind of time horizon have you got? Have you got an event risk? Like, are you going to put a trade on right in front of the Federal Reserve saying something because you just kind of have a feeling that something's going to happen? And then there's always the black swans, whether it's something like, 9/11, something maybe just like Trump decides to hit Mexico with some tariffs. These things, you can't be prepared for things like that. You can't know they're going to be happening, but you have to be prepared to be wrong. You have to be prepared that whatever trade you just put on might go really wrong, and I would say you need to get out of it quickly. You need to know where you're going to get out of, or you're going to need to know where you'd like to get out of something, if it's an illiquid market, if it's not going the way you anticipate. So, you got the classic stuff, you got to cut your losses short, try to stay with winning positions, know when to move your stops. If you buy something and it's going your way, don't wait for it to have a huge rally and then roll around and come all the way back down to where you got in. Don't leave that money on the table. managing emotions are really, really key, and you're going to have them. You're going to be pumping the air when you're making money and banging your forehead on the desk when you're losing money. You got to calm that stuff down. That's probably you're overtrading your emotions, if not your money. There's any number of other things, but I'd say this really, in terms of expectations, just to wrap it up, it's 2 steps forward and 1 step back. If you're doing well, sometimes you're going to go through a period of time where it's 5 steps backwards, and you wonder if you're ever going to get a step forward again. So you have to be prepared to live with that as well.
Victor, thank you so much for chatting with us.
Jimmy, it's always a pleasure. Good luck to you, my friend.
My guest has been Victor Adair, co-founder of the Polar Futures Group. He's Senior Vice President and Derivatives Portfolio Manager at PI Financial in Vancouver. His website, polarfuturesgroup.com. If you have any questions for Victor or any of our other guests, you can send them to info@howstreet.com. Our YouTube channel, Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.